Hey, good morning, options traders, and happy Friday to everyone. Well, a good question for the group today is what's it worth to convert losses to zeros? Well, what in the world does this mean? Well, it's a highly overlooked concept when you are trading options, whether calls or puts. And what a lot of traders don't realize is that the reason you're paying the option premium is you are converting losses to zeros. And that's a big benefit, and that's why there is a price. And that will give you a better perspective of whether you should buy the option, sell the option, or let it ride out to zero. So let's go take a little deeper dive here on what exactly this means. What's it worth to convert losses to zeros? Before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start with a long stock position. As I've talked about so many times in previous videos, our risk graph for long stock is a straight line. So if you own shares of stock at 100, you make dollar for dollar up, but you lose dollar for dollar down. So when you own shares of stock, this is the risk, is this downside. But now let's compare that risk graph versus long calls. So let's say that the stock is right here at 100, and if it goes up, we've got 102, 103, and so on, down here 98, 99, and so on. So with the stock at 100, notice if you own the shares, you're going to make $1 with the stock at 101. You'll make $2 with the stock at 102, and so on up the line. However, if the stock price falls, then we start heading into losses. Stock falls to 99, you're down a buck. Stock falls to 98, you're down $2, and so on down the line. Well, when you are trading shares of stock, this shows that the stock's expected value is zero. Whether you're looking for tomorrow or next year, your best guess for the future stock price is today's stock price. Now, don't confuse that to mean that the stock price can't move. It could be very far above that or below it. But your best guess is the current stock price. So the stock's expected value is zero, but what happens if you buy a call? So a call option can make dollar for dollar up, at least as we get closer to expiration, if the stock price rises, just like you can with shares of stock. The difference is down here. See, the call option doesn't participate in these losses. The payoff for a long call makes all of these prices to the left zeros. So you have to ask, is that a benefit? Well, sure, because now the call's expected value is positive. If you were to add up all of the zeros on the left and all of these numbers on the right, you're not going to get zero like you do with shares of stock. You're going to get a positive number. Well, now ask yourself, is that a benefit to convert all of those losses to zeros? And the answer is obviously yes. We'd like to have a positive expected value. We'd like to know that we can't participate in losses to the downside. So yes, it's a benefit. Well, if it's a benefit in the markets, you can be sure of one thing. It comes with a price. You have to pay for that benefit. And once we pay for the benefit, you'll gain other insights. So let's say the stock is 100 and the $100 call has an expected gain of $5. That's what we figured out in that previous slide, for instance. Let's say we add up all of the prices to the right, all of the prices to the left, within a certain range of where we expect that stock to rise or fall. And there's an expected number we could come up with. Well, if that number is 5, then yes, it's a benefit, and that means you're going to have to pay 5. So your overall expected return is 0. But the reason it's 0 for a call option and the reason you have to pay money for them is because they have a positive expected outcome. Now, a lot of traders think, oh, well, when you buy an option, you're expected to make money. Well, that's not true. Or when you sell an option, you're expected to make money. That's not true because the value of all of those benefits must be paid for. So why wouldn't you pay less for them or more for them? Well, this is what happens in a two-sided market where we have buyers and sellers. Let's say that you could pay $5, but you were expected to make 6. Well, that would be a fabulous deal. Who wouldn't want to pay 5 to have a positive expected outcome of 6? And because of that, buyers will flock to this option and start bidding up its price. until that price goes to $6. Well, what if we went in the other direction? What if you paid $5 but you had an expected value of 4? Well, no buyer is going to want that. In fact, it would be a great deal for the sellers. So now we're going to have sellers pile in and start selling this, and therefore the price is going to fall until it hits 4. So the point to understand from that is that once we know an option's expected gains, that is going to be the price that you pay. And this is exactly how Black and Scholes came up with the Black-Scholes pricing model. They looked under that bell curve and said, here are the values of all possible outcomes for this particular call option. And again, let's just say that it comes up to be 5. Well, that's the price that you should pay for that option. And because you've bought this option that blocks out all of those losses, converts them to zeros, you have an insured position. And that's why if we look at the long stock position here in black, it's a straight line. But if you buy, let's say, the $100 call, notice that it curves. So you don't participate in the losses, at least to the same degree, to the downside. So if the stock is trading at 100, yes, you might have a 50 delta. You're behaving like 50 shares of stock here. Whereas if you own the stock, you would have 100 deltas. Do you see how the angle of this black line is steeper than it is for the red? If that's a little hard to see, just extend these lines out, and you can see that the blue arrow is pointing higher. We have much greater deltas on the black line. Well, why buy the call option then, if we're not going to behave dollar for dollar like we do with shares of stock? And that's because you have an insurance policy on this call option. And that is weighing on those deltas. That's what's reducing your deltas. Now, on the other hand, let's say that that option goes very deep in the money, way up here. Well, if you're trading shares of stock, you're on that black line. And if you're trading the call option here on the red line, those two lines pretty much overlap. You can't tell them apart. And what this is telling you is that your insurance policy is useless. It's become absolutely worthless. And that's why, if we look at a bell curve over here, let's say the stock is at 115, current stock price is right there at the center of the bell curve. And what it's telling us is that for a given volatility and or time to expiration, there's a certain width of this bell curve. And what we're saying is that no matter how low that stock price may go, given this bell curve, it's never going to allow that insurance policy to kick in. You're always going to be operating on this straight part of the line. And so if that's true, that option is no longer an option. It's going to behave like shares of stock. So the point to see is that as you start getting closer to at-the-money options, that the insurance policy is carrying more weight, and that's what's causing this red line to bend. Now we can get the same idea with short shares of stock, just in the opposite direction. If we have short shares versus long puts, what we saw before, these are various stock prices. Well, if you short the shares, you're going to lose if the stock rises, but you're going to gain if it falls. Just the opposite of long shares. So what happens when you buy a put? Well, you're not going to participate in these losses if the stock rises. You are converting all of those to zeros. And is there a benefit for that? Yes. Because what's your expected payoff now for this put option? It's positive. All we have are zeros and positive numbers for the option payoffs. So yes, that's a huge benefit, and that's why you must pay for the put. You are buying an insurance policy. And so if we compare short shares of stock to our put option, we get the same idea. We can see that down in this area here, that the short shares and the long put are behaving identically. And that's because the insurance policy on the put is just long over. The stock has fallen so much that the insurance value of this put is zero. But if we start moving towards the strike, let's say 100, now we're starting to pick up that insurance policy. And that's why our deltas are not as steep as they are for the black line, for the short shares. And if your deltas are not as steep, you don't have as much risk, and that's because, again, you have an insurance policy. So now once you understand the benefit of long puts, that they have this positive expected payoff, what about short puts? Same idea for short calls, but I like to bring this up for short puts because everybody loves to sell puts thinking that they're free money. Well, take a look. Here are the outcomes for the short put. They are the opposite of the long put. When you sell the put, you are not participating in gains to the upside, but you are participating in losses. So you might be thinking, well, who would want that deal? I can't win, but I can certainly lose. Well, but remember, you're going to get paid for that. But the thing to see is that when you sell a put, your expected value is negative. And so that's another way to understand why you're getting paid. That's why you receive cash for selling that put. It's not because it's free money. And if you ask most traders, what's the benefit of selling puts and why are you doing that? They'll tell you because they have an expected gain. And that is not true. The outcome is expected to be negative. It's the opposite of the long put. And once you understand this whole idea of converting losses to zeros, it becomes very apparent. When you sell puts, your payoff on that short put is zero if the stock rises, can't make anything. But if it falls, you do participate in losses. So overall, the expected value is negative, but once we account for the cash that you received, it's simply zero. So whenever you're trying to figure out if it's worth buying a call or a put, you have to ask, what's it worth? And the question is asking, what's it worth to convert all of those losses to zeros? And understand that converting losses to zeros has value. And that value is the current market price. So long options, options you buy, have positive expected payoffs, while short options have negative expected payoffs. But both have expected values of zero overall once we account for the prices, and that's what we call the fair value. So once you understand this idea of converting losses to zeros, this is why I will, a lot of the times, not always, but let long options ride to zero. And so many traders say, oh, you should stop the losses after you've lost 20% or 50% because of theta. And they're not understanding the reason that you buy the option is for the insurance policy. And like any other insurance policy, you're looking for a block of time. You don't buy an auto insurance policy and say, I want to cancel it after 2 months because of this negative theta. That's what's happening when you're closing off many of these long options early. You're not giving them the full time for your expected outcome to come true, understanding that you have an insurance policy in place that whole time. So anytime you're figuring out, should you be the buyer or the seller, very good question to ask is, what's it worth to convert all potential losses to zeros? And that will help you to make your decisions. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.